Business owners use Section 100-79 because it allows them to reduce taxable income when they buy equipment used for business. The strategy is simple. A business makes money, the owner buys equipment the business genuinely needs, and then part or all of the equipment cost may reduce taxable income depending on IRS rules and the business situation. Imagine a small trucking company earning $120,000 in yearly profit. Without deductions, the full amount may be taxed. But if the owner buys a qualifying work truck, trailer, GPS system, and tools worth $40,000 for business operations, taxable income may decrease significantly. That does not mean the equipment became literally free. This is where beginners get confused. The business still spends real money. The difference is that the government may allow the business to lower its tax burden because the money was used to improve business operations instead of being left as taxable profit. A smaller example makes this easier to understand. Imagine a business normally owes $20,000 in taxes. After qualifying deductions, maybe the tax bill drops to $10,000. That saved $10,000 helps offset part of the equipment cost. This is why many business owners say the government helped buy the equipment. But there are rules. The equipment usually must be used for business purposes, properly documented, and placed into service during the tax year. If someone tries to disguise personal luxury purchases as business expenses, they risk audits, penalties, back taxes, and interest charges. The system only works properly when the equipment genuinely supports business activity. The smartest business owners do not use Section 179 to chase appearances. They use it to improve cash flow and production capacity. A beginner may think the goal is simply avoiding taxes, but disciplined operators focus on increasing efficiency and revenue. A luxury watch usually produces no income for the business, while a delivery van, commercial oven, industrial machine, or editing computer may directly help generate more money. That difference matters. A bad purchase does not become smart just because there is a deduction attached to it. Spending $80,000 on unnecessary equipment simply to avoid paying $20,000 in taxes still results in losing more money overall. Smart business owners first ask whether the equipment will increase production, save time, reduce breakdowns, or improve customer service. The tax deduction becomes the bonus, not the main reason for the purchase. The beginner execution process starts with having a real business that earns legitimate income. This can be a landscaping company, photography business, online store, trucking operation, restaurant, contracting business, or freelance service. The important thing is that the business performs real work and generates revenue. After that, the owner identifies equipment that genuinely improves operations. A photographer with a slow laptop may spend 5 hours editing videos. A faster computer may reduce editing time to 2 hours. That time savings allows more client work, which increases income. The equipment now becomes productive. Before making large purchases, smart operators usually estimate yearly profit and speak with a CPA or tax professional. This step matters because many people buy first and learn tax rules afterward, which creates expensive mistakes. A CPA helps determine whether Section 179 makes sense, how much deduction may apply, whether financing changes the strategy, and whether the business can responsibly handle the expense. Once equipment is selected, the business owner must make sure it qualifies and is actually operational during the tax year. One major beginner mistake is buying equipment at the end of the year that never becomes active before year end. In many cases, the equipment must be placed into service, meaning it is ready and actively being used for business operations. Documentation is also critical. Businesses should keep receipts, invoices, financing agreements, mileage logs, maintenance records, and proof of business use. Many businesses lose tax disputes not because the strategy itself was illegal, but because documentation was weak. If the owner cannot prove business use, the deduction may be challenged. This is why disciplined bookkeeping matters so much. Many businesses finance equipment instead of paying full cash up front. This is another reason the strategy can improve cash flow. Imagine a business buying a $70,000 truck with a $10,000 down payment and financing the remaining balance. In some situations, the business may still claim qualifying deductions even while paying monthly over time. That can create a powerful cash flow advantage because money that might have gone entirely toward taxes is instead redirected into productive business assets. But this also creates danger if used irresponsibly. Debt payments still exist even when revenue slows down. Smart operators calculate monthly loan payments, maintenance costs, fuel costs, insurance expenses, repairs, and expected income before committing. A huge mistake is buying expensive equipment before enough customer demand exists. Smart execution usually follows this order: demand first, expansion second. Advanced business owners treat equipment planning like a yearly system instead of making emotional purchases. Early in the year, they review business performance and meet with accountants to estimate taxes and growth opportunities. Mid-year, they focus on improving operations and increasing revenue. Later in the year, they analyze bottlenecks and decide whether equipment purchases are financially justified. This timing matters because rushed end-of-year decisions often create wasteful spending. The best equipment purchases usually accomplish three things at the same time: reducing taxes, increasing efficiency, and increasing future revenue. A landscaping company buying faster commercial mowers may complete more jobs weekly while reducing labor time. The equipment now improves production while also creating possible tax advantages. Disciplined operators also monitor numbers continuously. They track revenue, profit margins, debt obligations, maintenance costs, equipment usage, and tax estimates. Equipment sitting unused becomes a liability because it still creates insurance costs, interest expenses, repairs, and storage costs without producing income. Emotional buying destroys businesses slowly. Strategic buying strengthens them. This is why smart business owners avoid pretending personal luxury spending is business investment. Business use percentages, vehicle rules, and documentation requirements matter heavily under tax law. Legal compliance matters because aggressive misuse can create audits and penalties. Another advanced lesson is maintaining cash reserves. Some businesses destroy themselves by spending nearly all available cash chasing deductions. A tax deduction does not help much if the business later cannot cover payroll, repairs, or operating expenses. Smart operators often keep emergency reserves, maintenance funds, and operating cash available even after equipment purchases.